Financial statements. All businesses use them, all businesses need them. Different financial statements focus on different areas of financial performances. But why is this important? One is able to look at the cash flows of their business, any outstanding debts, and the value of the company's assets. Ultimately, when unsure, a business is able to evaluate their financial position. Financial statements are also important to the stakeholders. Investors and creditors do not have time to gather all the information themselves and figure out the performance of the business. This makes them beneficial as they can evaluate the company's performance and decide whether they would like to invest in the company or lend money respectively. The company's managers are also able to communicate with interested outside parties about the business success by publishing financial statements. There are three main types: income statements, balance sheets, and cash flow statements. These are necessary to really understand where money came from and where it is now. Income statements or profit and loss statements summarize the business earnings, expenses, and net profit or loss over a specific period of time. So how is it set up? Income statements are divided into three main parts: total revenues, total expenses, and net income. Sales are at the top, with each step down making a deduction for some certain costs or other operating expenses associated with earning the revenue. At the bottom, after deducting all expenses, you learn how much the company actually earned or lost during the accounting period, or the bottom line. If income shows to be more than your expenses, net profit is proven. However, if expenses are more, a loss has been made. Ultimately, it shows the profitability of the business. Balance sheets, also known as statements of financial position, is a snapshot of the business's assets, liabilities, and equity up to a specific point in time. It ultimately is a physical representation of the accounting equation. That is, assets, what the company owns, equals liabilities, what the company owes, plus shareholders' equity, money that is left in a company sold all of its assets and paid off all liabilities. The assets must be balanced by a company's financial obligations along with the equity investment. How is the balance sheet set up? Assets are displayed on the left-hand side in accordance to their liquidity, whereas liabilities and equity are on the right. It helps owners quickly get a handle in the financial strength and capabilities of their business. Cash flow statements uses and reorders the information from a company's balance sheet and income statement to show the actual inflows and outflows of cash coming into and out of a business. This is important because a company needs to have enough cash on hand to pay its expenses and purchase assets. It shows you changes over time rather than an absolute dollar amount at a point in time. The bottom line shows the net increase or decrease in cash for the period. How is it set up? It is usually divided into three main parts, that is, operating activities, investing activities, and financing activities. Financial statements are the key to unlocking a world of financial opportunities.